Alrighty, folks, we are going to have a conversation that I don't think we've ever had on this channel, which is hard to believe given we've done 15,000 videos. But we're going to talk about how real estate investors with a decent sized portfolio and a decent amount of experience, how do we think about debt? How do we think about equity? And then how do we think about cash? Obviously, some of this is going to be based on where we are in our investing cycle. Are we in growth mode? Are we in chill mode? Are we on the cusp of a recession or not? Mr. Cody, you are really managing your portfolio, really simplifying as you've shared with us in the past. But how do you think about debt, equity, and cash? Feel free to start anywhere you'd like.
Well, I think that anybody who's trying to grow their portfolio, they're not coasting. I think you have to be actively looking at everything pretty regularly and being willing to adjust what you've got going on, because life happens, things come up. And example, 1 month ago, I didn't know I was going to have to redo my sewer line. Then I had to redo my sewer line. And so I had to come up with money. Things happen. It could have been much bigger than that. But as you're building a portfolio, this is what I heard from Ben Mala talk about takeaways from millionaires. You always have to be adjusting your pieces. When stuff comes up, figure out how you can move it. And nothing has to be set in stone, is what I found.
Yeah. I mean, when I think about our investing journey and I look at our first 5 years, really what was most important for us, I guess it's probably always been this way for us if I think about it in real time. For me, the debt structure was always important because I didn't want adjustable rate mortgages. I saw what happened in the Great Recession. Also, I don't like short-term debt. And let me define that, like 5-year balloons. I had a 5-year balloon on a seller second on an apartment building we bought that happened to come due during the Great Recession. And before I made that phone call and just shared what was going on and got another 5 years, which, by the way, she didn't have to do. She could have foreclosed. She didn't want the property either, thankfully. I won't do 5-year debt, right? And I can't think of a situation I would do 5-year debt. Maybe if I got a 40% discount or something. But for me, it's I think about the debt structure a lot. I don't know about you, but what do you think?
Well, my favorite debt structure is mid to long-term interest-only options. And I got into a productive discussion with a guy who's worth north of $10 million here in Moses Lake. And if you're worth north of 10 million, you're doing really well. But if you're doing that in a small town, you're doing very well.
Really well. Yeah.
Yeah. So he was super opposed to interest only. And I was like, well, why is that? He's like, well, you got to pay it down to build equity. It's like, well, if you have this long-term strategy, he told me his strategy is 15, 20-year holds. Like, show me a 15 to 20-year period where it didn't go up in value in any market you've invested in. He's like, well, that's never happened. I'm like, great. So what if we did interest only to maximize the cash flow on a loan product that allows you to hold it for that period of time?
Yeah.
And so I think tailoring it to maximizing cash flow for the long term is the answer, not so much of just paying it down. Some people love amortized loans and 15-year AM, pay it off as quick as possible, but
there's a lot
least stressful.
Yeah, there's a lot of DSCR lenders over the last 24 months. Both Convoy and Velocity are two that I work with on this show. They both offer 30-year fixed rate products, but both have an option of up to 10 years interest only. So again, if we play this out, you get 10 years of interest only, then it reamortizes to basically a 20-year payment. So you get the beauty of a 30-year note. So you've got like the downside protection, like of interest rate spiking, but you also free up additional cash flow, for the first up to 10 years. You don't have to do 10 years, but both of them have up to 10 years. So I see a lot of logic in that with, when I hear you talk about IO or interest only.
And it just depends what people want and the business that they're building. My business was build really big, right size, so that there's a strong foundation that's bigger than if I just went a little bit slow and steady. And there's nothing wrong with that, but it's what I did. And so the way I look at it, if I'm looking at borrowing at $1 million at 6% interest, the difference between interest only and a 30-year AM is $1,000 a month.
Yeah.
When times get tough, an extra $1,000 a month, it's exactly 1,000 actually.
Oh, okay.
So I mean, it goes a long ways. That adds up when you start borrowing $3, $4, $5 million. And there's a great argument to say you should pay off your debts. But what I like to look at is if I had 5 properties, I'm saving $1,000 a month. I could take the amortization of all of them and hammer one property. And then it becomes like that debt snowball. You attack one, and then the next and the next, rather than trying to attack all the debts all at once.
Yeah, again, there's a lot of things out there. Again, I love how we think alike on some things and differently on others. We're obviously 30 years apart in our investing career or our ages, so it's the other thing I think about is I've gone from growth mode to chill mode, right, where I'm not ramping it up. And one of the things that we did as I converted from growth mode to chill mode is I actually went back and looked at my equity position. Because one of the things I did is we exited growth mode is I went from, a portfolio that probably averaged 75% levered, so 25% equity, to something substantially below 50%, right? But again, different lifestyle, different game plan, different plan for the future. I think being that unlevered in growth mode is not very helpful.
Well, let's say you were back and you were 30 years old. Yeah. And you had 20 rentals, 20 total units. So that could be 4 properties, 20 total units.
Yep.
And maybe you're cash flowing $4,000 a month. You'd like to get to 20. So $200 a door, basically,
right?
Is what you're currently doing. Would you opt for amortized debt? Would you opt for interest only? What would you do given today's products that you know about, because you're more connected now than you were then?
Yep.
To scale up to that $20,000 a month goal. Because there's some people listening that are in that position.
Oh, no, absolutely. And that's why I'm giving this some real thought. Because again, if you look at my track record, I never did IO debt except on seconds. But to your point, being more connected, knowing the plan, I would definitely take the 10-year IO product. I would definitely get a DSCR 30-year fixed rate product, because I like to protect the downside. In this case, the downside is an interest rate shock higher. So yeah, I would take an IO product today for sure. Because again, you got to remember what we're typically buying are value add properties from distressed sellers, which means if you're buying a house, you typically can turn that in 3 to 6 months, right? From a slumlord property to something that's amazing, if not faster. But when you're going to turn a multifamily property, like a 5-unit, an 8-unit, a 10-unit, I don't know that a lot of people realize this. It actually takes 2 turns, right? To take it from a slumlord property to market rent, it's not one jump. Unless you vacate the entire property and just eat cash flow for months, you're going to recycle 1 unit at a time. And you're not going to put an A-class tenant in with C-class tenants. You got to go C-class to B-class and then B-class to A-class. So you got to have a long track record. So in this environment where I'm adding small multifamilies, 5 to 20 unit buildings, I would take IO debt all day long in my starting mode for sure.
You mentioned Convoy. I've never done a loan with them. I have gotten some 30-year fixed DSCR loans with 10-year IO. So I actually did do that on a couple small resi properties. But on those products, people are putting 20% down, fixing it for 30 years typically. And is there a big prepayment penalty on that? Or are they locked in?
No, yeah. If you're going to get that product, you're going to probably have a 5-4-3-2-1. You might have a 3-2-1. It's definitely for the set it and forget it kind of strategy. But yeah, there will certainly be a prepay for sure.
Well, that's probably the smart strategy. I mean, people that are transacting in and out of real estate can get burned.
Absolutely. Yeah. I think the product's pretty sexy. Again, I can introduce you to the founders if you want, offline, but at least worth the conversation is compare with what you're getting. But the last thing to think about is cash. This is something I see you spending more time on recently in some of these conversations on and offline. For me, I was lucky enough that both Olivia and I worked. Both of us made 6 figures the last 5 or 6 years of our careers. And, we look to our careers to produce those chunk money. But for somebody who's not, doesn't have a day job, doesn't have that flexibility, cash is always important, because cash is what could send you into bankruptcy. Like when you go study accounting, which, I have an econ and was an accountant for years. it's funny how people talk about balance sheet, which in this example is equity. Maybe they talk about income statement, but it's really the cash flow statement that can kill you. If you're equity rich and cash poor, you can go bankrupt if with bad timing.
Oh, absolutely. And I spent the last year plus right sizing the portfolio, going from a couple hundred rentals down to 100 rentals, and now I'll scale out of a place of strength rather than weakness.
Exactly.
But getting that cash in, selling out of some liabilities, some of the properties I sold out of that I got 6-figure paydays out of are still negative cash flowing. They're still in the process.
Alligators.
I got paid for it on a good exit, but I would not do any of those deals again.
Exactly. That's a lesson we all learn for sure. Yes.
Yeah. It's not worth it. If you just buy stuff that cash flows, it's hard to go broke. I mean, things pop up. Yeah. And one thing for some of the listeners, the thing with real estate loans is you can't just typically get money tomorrow.
No, the other thing that you really learn in this game is the easiest time to get a loan is when you don't need one. But if you ever need one, it can be remarkably hard to get one.
It's tough. And what I have found that has really helped me out, because I spent all of my cash, and I think I mentioned this to you, to go from cash flow negative to cash flow positive. And now I have income. But I spent all of my money. It's expensive to own 100 units,
yes,
especially when you own a bunch of them by yourself. And it costs a lot of money, and you learn along the way. I ran out of cash. I got everything to cash flowing, and then I got a $12,000 bill for a sewer line. And so I can't just go to my banker and say, hey, I want money. It's going to take me 45 days to get a 6-figure cash out. So what I actually resorted to, I'm curious on your thoughts on this. I got a 0% interest for 18 month no, it's actually 15 month credit card. And instead of getting the 30% interest cash advance, I did an owner contribution for a 3% fee to Appfolio and got the money. Yeah,
you got to do it like if you're in that situation, you got to do it. I think that's a very creative answer to the problem, but it also points out, frankly, your Achilles heel and why you're actively looking to raise cash, because you don't want a second sewer line or a roof or whatever to just take you out. So completely understand what you're doing.
Yeah. And as soon as you get to a position, for the people that are watching, as soon as you get to a position where everything's cash flowing, your liquidity basically buys you time, because everything can be fixed with a check. So if something pops up, you're just waiting for the income to stack back up. And that's how I'm looking at my stuff. That 0% line of credit bought me enough time for me to start building reserves. And while that's not what you want to hear, that's the reality of what a lot of people find themselves into. And your liquidity is super important to build over time, because it buys you your most valuable asset, which is
it's the other thing it does for you. And you might be so young, you're still made of plastic, but for a lot of us old people, it removes stress, right? It removes stress from the situation. It removes sleepless nights. And there's no price I would like if I ever can't sleep because of something in my real estate portfolio is over levered or whatnot, I wake up the next day and sell whatever said thing is. Like, it's happened a couple of times. Like, I still remember, like, people ask me all the time, Zuber, you did really well during the great financial crisis. Did you miss anything? And there's always this one building, this one 10-unit building that I had locked up. The only way we could do it, because we were so active, is I would have had to dip into our emergency fund for the down payment. And that was something I always said I would never do, but it was a deal of the lifetime and yada, 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 yada. And my wife, again, Olivia, is always smarter than me. She's like, no, that emergency fund is for just in case sewer lines or whatever that could take our entire portfolio out. So what I did in that case is I gave it to a friend who bought it and made $500,000 in 4 years. I still think about it. I still drive by it on occasion, but Olivia was right. We can't now, as it turns out, it worked out. It would have worked out because we had nothing break, but I didn't know that at the time. And frankly, if I would have signed the deal, it's the habit. Yeah.
You build good habits and you definitely preach that.
Yeah.
So, your habits are everything. And that's why I say I'm not doing that. The motel conversions, I got out, I made money. did good. They're going to make money as long as they operate it correctly. If they don't operate it, then, same with any deal. But
Sure.
I wouldn't do it again, even having made enough money to live on for a couple of years out of those deals.
Yeah.
It's not worth it because the stress that it brings,
Amen.
whether it's on the portfolio or on the individual, is not worth it. And I really hope that the listeners take that away.
Yeah.
There's a lot of ways to make money, and some are not worth it.
No, at the end of the day, folks, you make money in real estate. I always tell people the get rich formula is remarkably simple, but you all hate step 3. Step 3 is it takes a decade, right? And the only way you can get to the decade is if you keep the properties for a decade. You can't bust out. If you have bad debt or over levered or lack of cash, you can bust out. You got to start over. You don't want to do that. You got to set yourself up for a long-term hold.
Yeah, super important. And I mean, I look at even my first deal, I'll be able to retire off of my first deal by the decade point, just based on if I bump rents 4% and it keeps up with the cost of everything going up like crazy, we're set. Now we just had rent control. So now it's 7% plus CPI, but we'll see what happens there. It's important to manage everything and be active with your portfolio.
Folks, I love what you're doing. I love that you're building a much stronger foundation that will allow you to have a lot more optionality into the future. If somebody wanted to follow your journey, where do they go?
Cody Davis Business Adventures on YouTube.
There you go. And when do you post?
Tuesdays and Thursdays, 3 p.m. Pacific.
There you go, Cody. There you go. Cody, you're amazing. Thanks, brother.
Thanks.